Well, good Friday, everyone. Welcome to Trading a Smaller Account. I'm Connie Hill, sitting in for Barb Armstrong today. As you know, she is back from surgery and doing well, just filling in for her for a little bit of time. Today, I wanted to focus on a couple of things that some of you have expressed some interest in, and that is being able to set multiple targets depending on what you see on the chart. So today, what we're going to focus on is setting targets not only based on price pattern, but on percentages of gain depending on what the stock does for us. All right, so hang tight. We'll have quite a bit to go through here today. I am joined in the chat by Ben Watson, a great friend, known each other, worked together for 20 plus years. He's a great veteran of the markets. So as you have questions, go ahead, chat those in. I'll keep my eye on the chat. Ben will also have my back if there's something that I can't quite get to. Now, I do hope you're following us on X. I'm Connie Hill CS. Ben is Ben Watson CS, and we'll post educational content, things that we notice about charts, what might be going on in the market. We'll give you a write-up about some of those things because they might be interesting to you as well. All right, let's go through our disclosures. As we do so, I want to give a quick shout out to many of you out in the chat. Appreciate you being here week after week. We've got Paul, Barat, Lawrence, Joseph, TMTM, Jack, APA, Marcus, Chris, Ricebird, John, the Noble Savage, and many others. Kevin, Bill, Neil, happy to see all of you here as well as Mighty Mouse. Okay, let's go through our disclosures here. Options carry a high level of risk and are not suitable for all investors. We will be using the Paper Money software application today. It's what you download to your computer. It's the most robust version of Thinkorswim. We recognize when you're new to the software, you need some help, so take advantage of those classes that we do on that. The Paper Money is for educational purposes only, but I think it's a great tool to practice your strategies. Past performance is no guarantee of future results. Now, in this particular class, we'll take an overview of what's going on in the market. We'll just take a quick peek. We always want to be looking at some examples, and there's one example I want to follow up with you that we actually did a few weeks ago, kind of give you a progress report on what's happened with that particular trade. So let's get busy. This class, we have a $20,000 Paper Money account, and we base our decisions and our position sizing on the fact that it is a smaller account. Now, your smaller account might be a different value. Maybe your smaller account is 5,000 or 10,000. Or maybe you're somebody that says, I'm only going to dedicate a smaller portion of my portfolio or account to some of these shorter term type strategies, trying to generate some cash and build that portfolio. So we'll say that our max position size that we'll put out is $5,000. We won't spend any more than that on any single stock position. Our maximum risk per trade is going to be $400 to $500. And that's going to allow us to focus on short-term opportunities as well as maybe some intermediate type strategies and trends. And we'll go both bullish and bearish. In fact, I have some trades for both bullish and bearish directions here today, depending on how far we get. Okay, so those are the parameters of this class. Let's go ahead. Well, actually, I'll show you this. When we're bullish, these are the strategies we'll typically focus on. Buying the stock outright, long calls, short put verticals, buy right covered calls, short put verticals, long call verticals. And I know Barb uses a variety of those types of strategies depending on what she's seeing. We'll also have some bearish opportunities sometimes, right? We'll look at long puts, long put verticals, short call verticals. Once in a while, we talk about iron condors and calendars to take advantage of maybe neutral markets or markets that are range bound. Okay, all right, now we'll hop over to Paper Money. Just kind of see what's going on here today. You know, the market started out up really quickly, and man, they sold off really fast. If you were watching the market, and you may have noticed that as well. Let's kind of zoom in here. Yeah, you can see we gapped up on the open on the SPX, and then it's just like, man, it jumped out the window, didn't it? Big kind of I'd call that a candle there, a piercing line, because this bearish body is well into the body of the previous day's candle. And that is after setting a new all-time high. Okay, so the market seems to still be churning higher highs out. So we can't argue with that, right? On the NASDAQ, let's see how it's holding up. Looks to me like it gapped up here, not to an all-time high like SPX, but it did gap up. It's pulling back here as well. Now it is off its lows. There's a little bit of a shadow starting to develop here. So maybe we'll see the markets rebound, right? We'll have to wait and see. But, you know, for the price action of the day, yeah, it's still down about 0.25% as far as the index goes. And if we look at the volatility index, what would we expect? Would we have expected it maybe to spike a little bit here today? Yeah, maybe so, right? I'm going to zoom into maybe about this much time frame. It's interesting on the VIX, it's in kind of a narrow little channel. And maybe that's a little bit too much of a zoom. Let's maybe go start here. Okay. And you can see it runs up to a point, then it's been pulling back, and the lows keep getting a little bit lower and a little bit lower. And so do these high points. So the VIX kind of is coming down, not being quite as volatile, not as in as big of a range, not as much put buying as call buying as this area shrinks down. So volatility levels, I'm going to say, are not the lowest they've ever been. Okay. And it did spike up here today. We can see it went through the midpoint of this channel, even though it's pulling back here a little bit now. But, you know, down here in the 14s, 13s, 12s, where it was earlier in the year, you know, those are pretty small areas of volatility. But we get creeping up here, you know, 20, 19, 22, and so forth. Then we're going to be noticing a lot more volatility in the market, a lot more selling off activity. Okay, so that's kind of what we're looking at here. Now, let me see what Chris is saying here. You say, I assumed you hit your target almost immediately this morning. You had the perfect trade on for whatever had happened. Actually, the one that we put on took a long time to develop. And let's take a look at it first. We're going to go with Micron. Bring up its ticker symbol here. And this is a stock we go in and out of quite a bit. We trade this stock frequently. If we come over here to, we'll just stay here on the account statement area. On the 18th of August, we got into what? A long call vertical. And so we had a net debit of it of 95 cents, and it's just a $2 wide spread. And we put in our orders, we put in that, hey, if we can get out with a certain percentage gain, we'd be happy to do so. So we said, we'll be happy to get out at 174. Now, very rarely are you going to get beyond the difference in the spread, right? That $2. Very rarely are you going to get beyond that. Sometimes paper money does something that you wouldn't really expect in a regular marketplace. But you're right. First thing this morning, as the market headed up, it hit that target. We got filled at a little bit better price than what we expected. Okay. I want you to know it's not that common, but it is common for if you've got a target sitting out there and you've put an order out there, it is common for it to go ahead and execute that trade. Sometimes it is early in the morning when we get a big swing. And so if your order is sitting there ready to go, you don't have to try to catch it. I think that's one of the beautiful things that, you know, trading does for us, allows us to go ahead and put in an order to say, hey, I'd be happy to get out here, capture those profits for me. So yeah, there very well could have been several stocks doing that here this morning. And I just kind of put a note on here on the chart because we had got in here kind of looking at a bounce here off this 10 period moving average. That's a 10 exponential, and the red line is a 30 simple. We'll keep those on the chart quite a bit of the time. So you can see, yeah, it had a big gap up, ran up a little bit before pulling back. And maybe it's just right now, maybe an area of resistance on Micron. So that's great. We were able to get out because we had that order sitting there. Okay. That's the one I want to spend the most time reviewing with you. There's one I'm going to touch on. I don't want to go too far into this one. But I do think a little bit of analysis here would be helpful. Okay, I'm going to zoom in here through May through June. And this was a trade that we got into. This one was a short call vertical. We were bearish on it. It had this descending triangle pattern going on here, and it broke down through the bottom area of this triangle, we got in on what happened to be the lowest day. So from the get-go, this trade was not going in our favor. Okay, so you can see it came up here. We were short this 70 call strike here, so we wanted the stock to stay below 70, and it didn't, and it went really pushing through it quite high. Now, on this particular one, I wanted to buy back the short call leg and let the long call leg run. I think we could have done it sooner. Okay. Sometimes in my paper money account, especially if it's a trade that I don't go back to follow up with the class, sometimes I lose track of it a little bit. Okay. And so, quite honestly, the day that I decided to buy back the short call was right here. But I really think somebody could have known earlier and maybe put that plan into play much sooner. Okay. Looking at the chart, I want you to just say, where do you think you might have determined when you're like, okay, this thing has totally changed. It is not bearish anymore. Let's see what we can salvage out of the trade by turning it into a bullish trade by buying back the short call. I think there would be some reason, probably good reasons to maybe have done that on this big green candle day. And not just so much because it was above 70, because it was above 70 here, but because of the strength of that candle. That is a big bullish candle. And at that point, you're like, okay, we got in on the low and it's been making higher highs here. This might have been the definitive candle to say, all right, let's take some action there. Okay, so where we are on this trade right now, we bought that short call back for a big loss. And the idea with doing that is you're saying, okay, I'm wrong on the trade, but I've got time on my side. Let's see if that remaining call can run up and help pay off the deficit of what we bought the short call back for. Now, quite honestly, now I went through and ran the numbers. We're still down a little bit on it, which is unfortunate because we got 14 days left and the stock is right here at resistance again. Okay, maybe it's run up to it last couple of days. That might be a little bit hard to get over. So I wanted to kind of mention that to you, that is a way to manage those trades if indeed they go against you. So key is, one, you determine I'm wrong on the trade now. Usually that's with your technical analysis. And again, this big green candle here would have been it. Not so much here with this green candle or this green or red candle, just because they were in that area, because sometimes stocks might go up in that area and then just pull back again. Okay. Let's see. Vic says that candle also covered the gap from the 2 to 3 weeks before. Yeah, it definitely did. We go back here, maybe see that a little bit. In any case, that's what we could do. So in this case, we're kind of stuck in a hard place. I would like to see if we could maybe get out at a little bit better price, even though we might not be able to salvage the trade completely and make a profit on it. Okay. All right. Let's go take a look at some opportunities developing in the market right now. Knowing market's off its highs, some bullish things may have given us a signal, may have pulled back. Hopefully they're hanging in here for us. Let's take a look at our first trade we want to take a look at. Archer Daniels Midland. All right, these guys kind of fall into the staples area of the market, right? I think they're a food company. If you're not sure what a company does, click the analyze, come over here to fundamentals, and you can read up on what they do: procurement, transportation, storage, processing of merchandise, agricultural commodities. They're involved in a lot of things, okay? What has gone on here just recently? You can see by my white lines, I've drawn in a price pattern here. So this, I would say, is the flagpole, that steep vertical run in the price of the stock, just kind of a pop, pop, pop. We're not looking for very many sideways days to be in there. So we're looking for that short, just pop. And then we see a consolidation. Now, 2 to 5 days on that consolidation is ideal. This one, 1, 2, 3, 4, 5, 6, maybe 7 days in the consolidation. Sometimes it goes a little bit longer. Formed this flag. Now, as long as it doesn't totally retrace 3/4 of the way down the flagpole, we're in good shape. This one was getting maybe a little close. maybe a little bit more than halfway down the flagpole. But what are we seeing here today? We're seeing a nice little breakout. So we're going to put in a trade here where we're going to have two targets. One is based on the price pattern of this flag, and the other is going to be based on getting a percentage of the gain of the trade that we're going to put in right now. Okay. Let's take a look here. If we wanted to maybe put on a place where we think the target might be, we'll come over here to our flagpole. I'm going to duplicate it, duplicate that drawing. I'm going to go grab that duplicate, and we can place it in one of two spots. One, we could place it here at this bottom area of the flag and say, all right, our target goes up from there. That would be the more conservative target. If you wanted to do the more aggressive target, let's see which one I wrote down there. I think I did the more aggressive target. We would grab this line and we would put it at the breakout point of the flag. And that is a little bit more of an aggressive target. Let's see how high up that goes. That goes up to about 67 and some change, 67.37. Okay. So what we're going to do is we're going to say, okay, let's put a price target, maybe not at 67.67, but maybe go most of the way there, right? Say $67. So I'm going to write this number down here so that we can keep track of it. But that's going to be one of our targets when we set up this trade. Let's go over to the trade tab here. And I'll tell you on the different examples we used today, I did go out and poke through some of these weeklies to see if there was enough open interest that maybe we could get in a shorter time frame. Most of them just didn't have enough. So we're going to go with the October 17 expirations. We have about 42 days, and that's a common window, right? 20 to 40, maybe up to 50 days worth of time is something that commonly, if you're going to do a vertical, you'll look at that time frame. And you want to make sure, you guys know I'm a stickler for open interest. So I always have my column here of open interest because we don't want to get in here with 16 contracts or 14 contracts or 0 or 2 or, even 2 volume today. We want to make sure there's a lot of exchanging going on and we have tight bid-ask spreads. So what we're going to start out here on this one, we're going to do, let's see how this looks. We're going to do a buy vertical. Got plenty of time. It's automatically going to grab that 62.50, but we're going to spread it out a little bit wider. We're going to come down here to the 65. All right, which means we need the stock to move. We don't want, I wanted a little bit more aggressive of a target because I think we have the time to do that and it's just breaking out of the flag. Okay, so that's kind of another reason why I'm saying let's spread it out a little bit, give it a little bit bigger target. And I'm going to come lock this into place. We're going to say pay $260 for this spread for one set of contracts to gain what? To gain $5 minus $260, which is going to give us $240. Okay, we're going to risk $260 to make $240. It's going to give us a percent gain there, kind of in the 90% area. Okay, but let's put in the two targets like I told you. So what we're going to do here, we're going to say first triggers. Let's do first triggers OCO. Actually, I'll show you 2 OCO. We'll do a 2 OCO here. So we'll create an opposite order and an opposite order and another opposite order. We're going to have to create 4 of these. Okay. Oops, that one didn't do it right. Let's create opposite order here. Okay, let's get rid of this green one. So we have our buy order that we're going to put in for roughly 260. And then what we're going to do, we're going to set these up so there are some targets. Okay. We are going to do 2 contracts here because we can risk that. We can risk up to $500. Oh, we can only do 1 contract. I take that back. We can only do 1 because we only want to risk up to $500. This one's a little bit more than 500, so we're just going to do the 1 contract on it. Unless for some reason it creeps down to 250, then we'd say I'll sneak in an extra one. Okay. Now, let's go ahead and put in the first target here as the flagpole. Okay, so we're going to put the length of that. Well, we're not going to know what the price of the spread would be at that point, so we're going to change this to a market order. We're going to make this good till cancel. In fact, I'm going to do that on all of these. Make every single one good till canceled, because each of them need to be that way. And then we're going to go out here and put on the condition. So the first condition here is going to be when the stock gets to greater than or equal to most the height of that target from the flag, $67. Let's get rid of that period there. 67, that should be good now. Tab out of there. And I'm just going to make sure our verbiage is right down here. The security is greater or equal to 67. That's going to be our first target. I'm going to save it that way. Then we're going to put in a stop loss. Okay, where should a stop loss go on a flag pattern? If I say that to you, can you spit out the answer? Tell your dog, tell the computer screen. What should your exit be on a flag pattern? An exit could be, if it's not going our way, is if it comes back into this consolidation area. If it were today to turn around and close back down in here, would go, oh man, it's a false breakout. Got to get out of the trade. Okay. So I'm going to put in a value here that in my eyes, if I'm looking at it, I'm thinking, yeah, it is not breaking out anymore. And that's going to be about 60.85. That's where my mouse kind of aligned to. Your eyes might see it a little bit different. Let's see, what was that? 60, 80, 60. What did I put here? Yeah, it was about 60.80. All right, let's go plug that in now on the trade. So again, we don't know what the price of the spread would be at that point. We don't know. So we're going to put in here a market order. And again, we're going to put on the condition that if the price of the stock drops down, then we need to get out of there. So we'll go less than or equal to $60.80. Now we can adjust this target every day. If we wanted to cinch it up, cinch it up, cinch it up, we could. Okay, this is just our starting point. We're going to go ahead and hit save. Now, our other target that we're going to put in there is if we get a percentage of the gain. Ricebird likes 30% at the bottom of the flag. You like going 3% below. Joy likes 1% below. Yeah, something of that nature. Now let's see here. Was it Vic's saying no, it was 67.80. Did I put in? Let's look at that. You're right. That is way too far away. 60. Well, 60.80. I think that actually is right. Oh, you were telling me for the target, 67.80 on the target. Okay, good. We're in good shape here. All right, so let's go to our next one. We get 70% of our 240. Let's call it a trade. Okay, so what is going to be, say, our credit here is 260, but our max gain theoretically is going to be 240. Okay, that's the most we'll be able to gain in the trade. And we're going to say if we get 70% of that, man, we're going to be happy campers. What is 70%? $1.68. So $1.68 plus 260, it's going to give us 428. Just going to write that in there. That is the price where we want the spread to get us out. We'll leave it as a limit order here, but we've got to change that to 4.28. Now, because we're kind of doing a 2 OCO, we also need to put in a stop for this side of the OCO, right? If it hits our target first, that 70%, before it hits up there at 68.70, we still want to be out at the same point, okay? So that, we'll go back to it. We'll make that a market order again. And again, that was going to be based on the price of the stock going down to $60.80. So let's put it in here, price of the stock, getting less than or equal to 60.80. And let's make sure our verbiage is right. Actually, I need it to be greater, less than. I think I moved that and I shouldn't have moved it. We want it to be less than or equal to 6080. Okay. Now this is a way that you can put in multiple targets. Okay, so these two are our stops if the price of the stock goes back into the flag pattern. If not, we're going to be happy to get out if it hits the flag target, or we're going to be happy to get out if we get our profit target. Okay, gives you a little bit of options depending on what happens, because we don't know. You know, we're hoping that it goes up, but we don't know that it really will. Navik says you do not like to use stops. That's okay. You don't have to use a stop. It's a good idea to know where you want to be out, though, right? Even if, you know, have a mental stop, write it down. Because some of you might look at that and go, well, I only want to get out if it's there at the end of the day. I don't want to get out on an intraday move. And there may be some of you that have access to watch the markets and can do that. There might be others of you that can't. So just have an idea when you need to be out. Okay, let's send this guy on our whole one contract. And we're going to put it in trading a smaller account bucket. And if I come back for Barb, I'll try to pay better attention to this one, and we'll actually hopefully we're all covered there with everything we put in, but maybe be a little bit active with the stop loss if the stock does go our direction, and kind of move it on up as the move takes place. All right, let's go back to our charts here. And let's do another bullish opportunity that we're seeing out here. Let's go to NXPI. NXPY, it's in a price pattern as well. I hope your eyes are starting to notice when we have price patterns, because it can help us identify a target. Just with that flagpole, right, we expect the stock to move the distance of the target again. On this pattern, we expect, once it breaks out, we expect it to go the height of the triangle. So let's see what we've got going on here. This is an old resistance line. It's green. I don't know, a while ago I was drawing green lines, but now I'm using more white lines. Okay, but that is an old resistance area. So let's maybe just kind of zoom in here. And so we see a fixed point here of some resistance, but the lows keep going a little bit higher and a little bit higher, but we expect it to break out to the top side because that's the direction of the trend. Before the apex of this triangle, we expect it to break out there. So there are three places you can get in on an ascending triangle, okay? One is at the breakout point, okay? And you're trying to capture it here. And that's really probably the most common one. Another one is, say the stock breaks out and it comes back and it retests that breakout zone, and then it bounces up. That can be the second type of entry somebody could look for on that triangle. Now, the third entry, and that's the one that we're going to use here today, is if the stock is bouncing off support and there's enough room for it to make a decent gain before it actually hits that horizontal line. Okay, that's how we can use the third entry on this. Okay, not as common. That last entry, that third one, is definitely not quite as common. Now, Wiley's putting in a pitch here for Trading Price Patterns class on Wednesdays at 10 o'clock, which is what Barb Armstrong teaches that class on the price patterns, and she does a great job with it. All right. On NXPI, let's see, it's showing an inverted hammer. Would that be more bearish? Vic wants to know. You know, when I put this trade down, we really didn't have that look of the candle. Okay, we did not have this shadow to the top side here. We had a little bit of a shadow, but it was more of a green candle. It looked like it was bouncing. Now, your question is really valid there. Is this a reversal candle? If we were seeing today's candle up here at resistance, then we might think, oh yeah, it ran up there and then it ran out of steam. It's pulling back, okay? But it's actually here at a support level. And because it's at a support level, it's not really that much of a formation we might look at. I know it looks similar to an inverted hammer, right? We've got a hammer handle candle here with the green shadow, and this one looks like an upside down hammer. Okay, but we'd typically want to see that maybe at support, which it kind of is at support. What would that mean? That would also mean reversal to the upside. Okay, it's not in a perfect spot, but it's the same idea. And so I appreciate you asking that. Let's get rid of those drawings. Okay, what should our target be? Our first target. Our first target here should be maybe up to this 237 area. I mean, from 225 to 237, that's a decent chunk of area to have some sort of a profit. Okay, so let's have our first target on this one. We'll use the second row for this, be 237. Let's go 237.50. Okay, we won't go all the way to 65. We'll back it off a whole 15 cents. Okay, we'll put that in there. And then when would we know we're wrong on this? Looking at this formation, we know we're long if it closes outside of our support area. Okay, so here's my line here. Yours might look similar, it might look a little different. And in my view today, if it got down to maybe say, let's go 221.50. 221.50. I'm going to put a stop there because then that would look like, okay, it really didn't break out. Some of you might do that as a mental stop and see if it really closes there versus has an intraday move there. So if we go 221.50, that's about here. I would be looking at that saying, okay, we're wrong. That was a false breakout. Man, that didn't materialize. Okay, so that's what we're going to do. NXPI, never heard of NXPI, Bruce. It's a semiconductor stock. It used to have a ton of trading volume, maybe not as much now as it has in previous years. Today it's traded 750,000, which is ample, and it actually gives us plenty of contracts. Whether we're looking call side or put side, we've got a little bit of activity out there. The weeklies don't have as much. Okay, so that's why we're going to stick with these monthlies on this one as well. So on this is what I was looking to do here. Let's see how this looks now. Oh, this is going to work out all right. 220, 230, we're going to do another long call vertical. So we're going to say buy vertical. And it's a $10 wide spread here. And do you know what? That exceeds our position sizing. The price of it was like close to $5. And earlier today, I was hoping it was going to stay there. But because of our position sizing rules, we don't want to risk more than $500 on the trade. So this is what we're going to do. We're going to put in a stop here so that hopefully it would get us out at 50% of that spread price. Okay. It's not guaranteed, right? We would possibly theoretically be on the hook for all 520 here. Keeps going back down as we're watching here. So maybe it'll actually, by the time we place the order, it will be right at 500, but we'll just do the one contract, but we'll make sure to put that stop in loss in there it's not going to be foolproof, but to help try to isolate it. So if it got down to 50% of that value, then we would get out. Okay, so we're going to do two targets here. Actually, we're going to put in three possibilities here. So one is going to be a stop, and I'm going to say that's going to have to be what, at 260 for the stop based on the price of the spread. And we also said if the price of the stock goes down to 221.50, that is going to be another place. And then we'll get out at the target at 237.50 if it goes up that way. So we're going to put on another two, first triggers 2 OCO orders, but we're doing it a little bit different. We're going to have just one target, but two stops. Okay, so we're going to do that. Let's see, earnings are coming, Vic says. Let's go take a look at the chart. How soon was that? That's going to be on September 17th. So about a week and a half, it will have earnings. This doesn't say the time, if it's going to be before the market or after the market. Just says Central Time Zone. So probably put a time with that, kind of put it out there. I don't know when it'll be, if it's before or going to be after. Okay. So we might say, hey, we want to be out by that date too. Some people might want to trade it that way. If you're like, I don't want to hold this over earnings, you'd get out early. All right, let's go ahead with that. Oh, that was the dividend. You're right. That was the dividend. Okay, that's when the dividend's going to be paid. We're not worried about the dividend. Thank you, Wiley. Last one was July 21st. So it shouldn't be due until maybe October 21st. Okay. All right. You had mentioned that's where the earnings were, and I just went with it, not paying attention to that little icon, that that's when it actually pays the dividend. All right. I'm going to do one contract here. We're going to change this to a first triggers again, a 2 OCO. Okay. And again, we're going to make 4 opposite orders. Okay. So we're going to say create opposite order, opposite order, opposite order, opposite order. Okay. Ooh, this is good. Look at that. It's getting even closer to what we want, which would be nice. Okay. And like I said, when I was looking at it earlier, it wasn't exceeding $5. It was like $4.90. So I was thinking we might be able to get away with that. But we'll still just do the one contract, and we're really showing you how you might do that. Okay. So this first order here, let's have the first order be if it hits our target. Okay. So if the stock goes up to 237.50, that's where we want to put our first target. We don't know what the spread would be. I don't know what the value would be. Make that good till canceled, and let's go put, if it makes it there, we're going to be happy campers if it goes up there, making that run. And so this one should be greater than or equal to 237.50. And let's make sure our arrows go in the right way. This is saying less than, so we want to change it to be greater than 237.50. Would be happy to get out there. Okay, this next one, we're going to make it be for a stop. Okay, so on this one, what we're going to do, the first stop that we're going to put in here is 50% of the price of the spread. Looks like it's gone back up there to 520 now. So let's put that in at 2. Take that back. We're going to have to put that in at, if it goes against us, half of 520. Oh, now it's 515. I'm going to just put it down to 510. I really liked it at 510. That was much better. Okay. What's half of 510 is going to be what? 255. Okay. So let's go to our calculator here and say on this one, if it gets to be half of that amount, that's going to be 255, right? So we're going to say if the price gets down to 255, get us out. That's all it's going to be. And that's the loss that we would take on the trade. We're not hoping for that outcome, but it could happen. And then we're going to change that to a stop. It'll trigger a market order. We don't know what the price would be. Hopefully it would be something similar or close to. Now, if we have a big gap down, that could change that. Then, so that's going to be that stop loss order. Then the next one, we're going to put it based on the price of the stock. Let's see, one was on that. One was going to be based on if it comes out here to 221.50, right? Then we'd know it's breaking through there. So we're going to put this one as a market order, GTC. We'll mark both of those right now. And then this, we're going to come out to the conditional order. So if the price of the stock NXPI goes to greater than or equal to, make it this way, 237.50, we'll be happy to get out. And then the other order we're going to put at 231 or 221.50. Okay, the first one we did as our target. This one we did half the price of that. This one, 1, 2, 3, we just put in the price there. So this last one has got to be, if the price of the stock goes down to this one we did the 221.50, right? And we put that at the target. So this bottom one's going to be the 221.50. So again, another market order, good till canceled. We're going to put it based on the price of the stock. So each of the target orders has 2 stop areas that it could go to. So if NXPI gets less than or equal to 221.50, then we would want to get out. Now, it would be a good idea. Let's make sure that this is less than or equal to 221.50. That was a lot of number crunching, a lot of little orders. Okay, so it might be good for you to just kind of review it again. We don't have time to go review every single one. Okay, so my time is almost up. But it gives you a lot of control if you're like, I want this scenario. And then if it doesn't do that, I want this scenario. And then if it breaks down, it goes down to like it's not breaking out of the triangle. Okay, we want to get out at that condition as well. Okay, I threw in that extra one just because of not wanting to exceed our value, our position sizing. Okay, is why we did the other one as well, putting it at 50%. All right, any questions on these? Yeah, it actually would be first triggers 2 OCO. I just picked the one, didn't I? Thank you, appreciate that. Yeah, because we have 2 different conditions. So we want this will be an OCO order. This one will be an OCO order. And then our initial, hopefully we'll get filled here in just a moment. So very good. We'll send this on and hopefully it'll execute. Again, we can go back and trade and change any of those. We can go back and change any condition as long as it hasn't executed yet. Okay, so our focus here today was kind of showing you how price patterns, you can put targets for the price patterns and use them as one condition. And then you could use your values, right? If I get 70% of the max gain, then I might want to get out. Okay, just kind of showing you how you could mix it up. Or in this case, we said, all right, if we can get up here to resistance, and it just travels this space, then we want to get out. Okay, so giving you an idea of how you could set up those kind of orders, giving you a little bit more flexibility because software certainly is capable of doing that. Just looking quickly. Oh, John's wanting to know if this has an iron butterfly or something. It's just one trade that we're doing. We're only actually going to do the one spread, long call vertical. We're just putting all those conditions on the exit points. Okay, so it's really just a long call vertical is all this is. Okay, the OCO stands for one cancels other. And so on our trades where it's a let's just put it up here. Let's come in here to our working orders. You can see this little bracket here puts those 2 together, and then the other OCO order puts these 2 orders together. Okay, so that's why it's called a first triggers 2 OCO. And whatever target hits cancels the other one. Okay, so hopefully one of those gets executed. We're hoping it's on the profit side of things, but you never know. Things might not turn out how we expected them to turn out. Now, I do hope, I actually wanted to go to a different spot here. I do hope you guys are following us and are subscribed to our Trader Talks channel. If you do, it makes it a lot easier for you to find our content. Okay, we have our playlist for the different classes. Where this takes you to here on the home, sounds like we just got filled on that. We also have some other ones, so you can see what's coming up next. Well, it's going to be Cameron May. He's going to be doing advanced charting techniques. He'll be up at the top of the hour. And then we've got some other short videos that we're working on. We call them bite-sized content. They're less than 10 minutes, these videos. Latest one, Brent just did this week, where he talked about embedding a scan inside a scan. That was really pretty cool. And then I did one here where you could create a template. So if you do the same thing every single time and you are a person that likes repetition, likes to do it all the same way, this one teaches you how to do that. Okay, so take advantage of that. Now, I did not see a survey out there today. If there was a survey, Ben will post it again, but I did not see one. If this was helpful to you today, hit the thumbs up on the way out. Then others can find the webcast a lot easier by knowing that. And again, follow Ben and I. Would love to have you and interact with you on X. That's one of the ways that we can communicate with you. And so take advantage of that. You know, people sometimes will just ask me questions, maybe something that came up in class and they listen to a recording. Sometimes they'll ask a question out there. I'm always happy to respond to that. All right, you guys, take a quick break. Ben saying, hey, I'll see you in Dallas in 2 weeks. Yep, Ben is going to be there. All right, you guys, have a great rest of your Friday and enjoy your weekend. We'll follow up on this trade probably in a different class. We'll see you then. Bye-bye.